This is your technical update from the LMAX Exchange Research and Analytics Desk for Friday, May 13th, 2016. Euro dollar. So the euro right now is chopping around mid-range after recently putting in a 2016 high at 116.17. It's pulled back a little bit, but there's still some critical support further down at 112.17 that will need to be broken to officially put the pressure back on the downside. So right now the question is the euro putting in a higher low now ahead of the next major upside extension, or is this 116.17 high a key high ahead of a reversal lower that will ultimately take this market significantly lower over the short term to medium term? We have to remember that the market did stall out ahead of some critical resistance from that August 2015 peak at 117.09, which is major medium-term resistance, and again could set the stage for significant declines going forward. But the market will need to break back below 112.17 to officially force a shift in the structure. Sterling dollar. So cable has recently stalled out above 146.70. 146.70 is that key high that we had seen going back to the 4th of February, and the market tried to break above there back on the 2nd and 3rd of May, but was unable to establish a daily close above that level, which suggests that the pressure continues to remain on the downside. We'll need to see a break and a clear break back above 46.70 to officially take the pressure off the downside and suggest that the market is putting in a major base by that recent 7-year low at 138.36. But until then, the pressure does remain on the downside and there is scope for additional weakness. Dollar yen. So dollar yen has seen a nice correction over the past several days, though overall the downtrend clearly remains firmly intact, and a lower top is now sought out ideally somewhere around the 110.50 area in favor of the next downside extension back towards and eventually below that recent multi-month low at 105.55. At this point, we would need to see a break back above 11.89 to take the immediate pressure off the downside. Euro Swiss. So despite this latest pullback in Euro Swiss, overall the structure remains constructive, with any pullbacks expected to be well supported towards 109 ahead of the next upside extension beyond that recent high this week at 111.10 and towards the multi-month high at 112 further up. Ultimately, only back below 108 would compromise this constructive outlook. Aussie dollar. So Aussie has pulled back a good deal since peaking at a 2016 high at 78.35, with the market now looking to establish back below the 100-day moving average, which suggests that we could see an acceleration of declines towards next key psychological barriers at 70 further down. At this point, look for any rallies to now be very well capped ahead of 76. Dollar CAD. So dollar CAD has seen a bit of a pullback since poking above 130, though overall there is scope for additional upside as this market continues to show signs of basing out by those recent 2016 and multi-month lows at 24.61. Look for a higher low now by that recent low that we saw on Thursday at around 127.72 ahead of the next upside extension, which will be confirmed on a break above 30.16, exposing next key resistance at 32.19 further up. Kiwi dollar. So Kiwi remains well capped into rallies, with this latest rally now being capped ahead of 69, and the market could be looking to put in a lower top ahead of a break back below recent support this week at 67.16, which would expose 65.46 further down. At this point, any rallies should continue to be very well capped below 69, while ultimately only back above that recent 2016 high at 70.54 would mark a shift in the structure. SPX 500. So the S&P 500 is once again showing signs of stalling out above 2100, and the market now looks to be carving out a potential head and shoulders topping formation, which would suggest a significant decline if the neckline is broken, exposing that 2016 low all the way down at 1808 further down. For now, key support comes in by the recent low that we saw around 2035, and a break below would do a good job of accelerating declines towards 2021, below which would get the market more convinced of the possibility for a significant reversal back down towards those 2016 lows. At this point, only back above 2112 would really compromise this bearish outlook for the S&P 500. Gold. So gold has really been overall quite constructive, although we've seen a little bit of a pullback from recent highs after the market stalled just shy of that 2015 peak at 1307. Overall, the market remains very well supported on dips and should continue to be supported on dips ahead of the next upside extension beyond 1307 and towards 1400 further up. This doesn't mean that we can't see pullbacks in the interim, with the market potentially seen pulling back all the way to 1200 without it really compromising this constructive outlook. Ultimately, the market, if it holds above 1191, that previous solid resistance area now turns support, the overall structure continues to be constructive, favoring additional upside. Again, only back below 1191 would compromise this constructive outlook for gold.